Joining me now is Doug Braunstein. He's Wells Fargo's vice chairman. He is the former CFO of J.P. Morgan. He also led global M&A and investment banking at J.P. Morgan. He also ran an activist hedge fund. He's also been a public company CEO. And he's not even that old. Look at him. Doug, good to have you here.
It is great to be here, David. Thanks for having me.
I mentioned all those other things because there's a lot of different things we can discuss with you. Let's start, though, on M&A, which you are once again focused on, in part in your new role. What are you seeing? What are you hearing right now in terms of dialogue, to reference the Morgan Stanley CFO's comments on their call?
So I would say there are four factors, David, that make me cautiously optimistic about the M&A marketplace really going into 2025. The first is the data. So if you look at activity year over year, it's up about 20% globally, but up about 35% here in the U.S. And the level of activity is getting close in the U.S. back to pre-pandemic levels. So that's a very encouraging sign. The second thing I'd say that's really helpful is capital markets have adjusted to the new rate environment and are really wide open for business. So there's been close to record volume of investment grade issuance this year. High yield is up almost 100%. Term loan B, that non-investment grade bank market, up close to 600% year over year. Markets are open. The third thing that's really important is the spread between buyer and seller price is starting to come together.
Is it starting to?
Yeah.
So I wonder, because oftentimes in talking to practitioners, what I've been hearing is, I get something, it looks good, we go down the road, and then it falls apart. And it's not always regulatory, as you might expect, given the environment we've been dealing with. It is often actually price expectations.
Yeah, so again, I'll start with the data. So the average public company in the U.S. premiums paid this year is a little under 28%. That compares to a 5-year average of almost 32%. That doesn't sound like a lot, but it's that last percent or 2 or 3 that often is where a deal falls apart. So that valuation gap is compressing. The second thing is, actually, you look at the average multiples being paid, and they're pretty stable, but earnings and EBITDA are up. And so a stable multiple on a higher base makes for a great gap closing methodology. And the third thing is, stock market rallies, you're not trading off your 52-week low. You're trading off closer to your 52-week high, and it makes it much easier to be a seller.
They do engender confidence, of course, which is a key in this business as well. Are we ever going to see the big trades, the stuff that gets us excited in the media, or is that just still sort of more difficult in terms of getting it done?
Yeah, so actually, again, I'll look at the data. The $1 billion plus and the $10 billion plus deals are up quite dramatically year over year. So you're starting to feel that.
But we're off a terrible year last year.
But we are off a terrible year. I would say that the stability in financing costs, this robust stock market that's helping also buyers with their own equity as a form of consideration, and the depth of the capital markets, there is a significant uptick in large M&A discussions.
There is.
Yeah,
you're finding that.
Yeah, because I think people need stability. And so one of the issues over the last 24 months is, where are rates going? And I think, there's a general consensus that rates have certainly peaked. How quickly they come down is a question. But if you're the board of a large acquiring company doing one of those big transactions, you've got a much greater degree of confidence of what the next 12 to 24 to 36 months look like. Most companies,
even with the election looming, is that sort of keeping people on the sidelines? Not that many weeks away now.
It's, I'd say if you step back and you look, I've been on Wall Street for close to 40 years. If you look at the 40-year history, elections have short-term impact on the markets, but there's no discernible long-term impact, whether it's red or blue. I think what what again CEOs need to know is what are the rules of engagement, and then I can act. And I would say to you, I think the general driver of activity is confidence in the economic outlook and confidence in one's own business, and it feels pretty good out there right now.